Now let's move on to the double entry accounting system. So this goes back to or relates to that concept we talked about earlier about dual entry bookkeeping or dual entry accounting. So we need to introduce the T account, and that's what's in the center of this slide. The T account is a device or a convention for organizing and accumulating the accounting entries of transactions that affect an individual account. So that could be cash, accounts receivable, bonds payable, or additional paid-in capital. And those are just examples. So any combination affecting assets, liabilities, and equity can occur as long as the equation stays in balance. So again, we're going to keep referring to that accounting equation. Assets must equal liabilities plus equity. Now the left side of the account is known as the debit side, and the right side of the account is the credit side. So again, we still have our T account in the middle. If you can see, it's a little bit faded here. A debit indicates an increase in an asset, a decrease in a liability, or a decrease in shareholders' equity. So again, notice we talked about three different areas: assets, liabilities, and equity, all going back to that accounting equation. Now a credit indicates a decrease in an asset, an increase in a liability, or an increase in shareholders' equity. Again, referencing assets, liabilities, and equity. So in this slide, the normal balance for an asset, and we're using cash as the example here, is increased on the left side or debit side when cash is received, and decreased on the right side or the credit side when cash is paid. Now, in this slide, the normal balance for a liability, and here we're using accounts payable, is increased on the right side or the credit side when the company purchases items on credit, and is decreased on the left side or the debit side when the company pays its suppliers. So now take a look at this slide for equity. In this slide, the normal balance for an equity, and here we're using common stock as the example, is increased on the right side or the credit side when the company issues stock to an investor for cash, and is decreased on the left side or debit side when the company buys back or decreases the amount of its own issued stock in order to retire it. So in a double entry system, changes in account balances are recorded according to the following basic rules. Take a look at the blue arrow. To increase an account balance, record on the same side as the normal balance. Look at the yellow arrow. To decrease an account balance, record on the opposite side as the normal balance. This slide presents each major type of account and how the debit and credit columns are used to increase or decrease those accounts. For asset, expense, and dividend accounts, increases are recorded in the debit column and decreases are recorded in the credit column. For liability, equity, and revenue accounts, increases are recorded in the credit column and decreases are recorded in the debit column.